Brian Manning here with the weekly update. Let's get right to it. So let's see. So first of all, Monday this week, there was a lot of talk about inflation. So the interesting thing about inflation is that we've had all these costs of goods increase. And yes, the rate of inflation is slowing, but that doesn't mean that the cost of goods have decreased, right? So if you look at eggs, orange juice, doesn't really matter what the commodity is, that cost has already increased. And yes, the rate in which it's increasing has slowed down and it's reaching the Federal Reserve's 2% target, but it doesn't mean that the actual cost of goods is going down. So we're just seeing across the country that it's harder and harder for economically for people to make ends meet, especially going into the holiday season, because we've just seen more and more increase as far as the cost of goods are concerned. Also got some feedback this week from the Federal Reserve, and this talked about homeownership and net worth. I thought that this was something really great and worth looking at. So this looked at homeownership of renting versus owning. I'm bringing this up because I talk to a lot of people every single week about buying a house and should I buy a home or should I not? Should I wait? Should I rent? I think mortgage rates are higher right now. We look at this, so from the Federal Reserve, it looks at a comparison of renting versus owning and net worth. So in 2019, average renter's net worth $7,300, average homeowner's net worth $295,500. 2022, average renter's net worth $10,400. Almost $400K for a homeowner. Right now, renter, average net worth $10,000, average homeowner $415,000. So across the country in America, it's just proven over and over and over that the most amount of wealth and generational wealth is typically created in real estate owned. I bring this up because I talk to a lot of people that are comparing renting versus buying, and they're stubborn not to buy right now. And I just think there's great proof here that owning will continue to be worthwhile. This week on Wednesday, we got some feedback from the UK. This is on their inflation. So inflation in the UK was hotter than expected. I bring this up because the world is just globally interconnected right now. When you see inflation increasing in other places, it causes a little bit of a concern. And the concern is that, will cost of goods everywhere continue to increase. So that had a little bit of impact in the bond markets, a little bit of a negative impact on interest rates. Then we also got Thursday this week feedback from the QCEW. So this is an employment report. So there's two types of employment reports that we get. We get one from QCEW. That's definitely going to be more accurate. And then we get the BLS reports on a monthly basis. BLS reports monthly. QCEW takes their time, they're more accurate, and they report quarterly. So this is a report that looked at Q2 2023 to Q2 2024. What's amazing is the QCEW said at that time, looking at my notes here, that the QCEW said that 1.25 million jobs were created at that point in time. The challenge that I have, though, is that BLS says 2.5 million jobs were created at the time. It's such a difference, it's unbelievable. So the challenge that I have is that every single month we get these BLS reports. The markets are going to react based on what the BLS report says. If it's a very strong employment report, like for example, we got in the beginning of October, which was September's report, it was like 200,000 plus jobs that were created according to the BLS. That's what prompted mortgage rates to go higher. But then you look at what the QCEW did. QCEW, by the way, stands for Quarterly Census of Employment and Wages. QCEW came out and said, oh no, I'm so sorry. BLS has been overstating jobs by an average of 100,000 people per month. It's just frustrating because markets react based on what those reports say. And as you're starting to look at more and more data, I truly think that unfortunately it shows that the US economy is not as strong as the immediate reports come out and make it seem. Then we got CoreLogic today. So CoreLogic is a gauge of rent. This is on a year-over-year basis. This shows that rents went up 2%. So this is the lowest number in 4 years. The challenge that we have here is that the two inflation reports, so that's the PCE, that's a personal consumption expenditure, and the CPI, it's a consumer price index, both of them take shelter components into this. We've been talking about this for years. Well, in the PCE, the personal consumption expenditure report, this is the Federal Reserve's favorite gauge of inflation. When we look at that, that component makes up 18% of the report. The challenge that we have is that in the PCE right now, it's saying that rents are going up on average around 5.1% per year. But when you look at real life data from places like CoreLogic, it shows rents are only going up at 2%. So the shelter costs are lagging. Well, there's two problems here. One, when shelter costs were increasing because these numbers lag by a year or two, the Federal Reserve was definitely slow to hike rates as inflation was going up. Shelter costs were increasing in real time. The Federal Reserve was looking at this lag and they kept rates lower than they probably should have. Now we're in a position where shelter is coming down, the report shows that it's coming down not as fast as real time, and now the Federal Reserve is slower than they probably should be to cut rates. So it's always this pendulum shift back and forth. But again, as I said, unfortunately, it gets a little bit frustrating when you're looking at real-time data. It's giving you accurate, current economic information. Then you see what the Federal Reserve is looking at for their decision-making process, and it's not as accurate as what we're seeing in real-time stuff, and it's impacting our markets from there. Thanksgiving week. I can't believe it's already Thanksgiving. We're rolling into the holidays. I hope everybody has an amazing time with their family, if they're going to spend time with their family, or perhaps just get some time off. Our hours of operation Thanksgiving week starting this weekend all the way through the next weekend, and every single weekend, 365 days a year, are 8 a.m. to 8 p.m. If you're looking at homes, you need a pre-approval Thanksgiving Day. I'm available 8 a.m. to 8 p.m. Call me, text me. I'd love to help you. Hope you all have a great day.